Alrighty. So in today's video, we are going to be talking about choosing the best strike price for Iron Condors. So if you like to trade Iron Condors, or maybe you want to trade Iron Condors, then you gotta know what are the right strike prices to choose. Okay, so the selection of Iron Condor strike prices can be broken down into two parts. Now, the first part is in selecting the short legs, and then the second part is in selecting the long legs, which basically define the wings of the Iron Condor. All right, so let us get into the short legs first. So how do you decide what strike price to choose for the short legs? So for this, there are two methods. So the first method is by price level, right? So that means you are going to choose the specific strike price based on the price level. So for this, you want to first identify the support levels that's below the current price. So as you can see down here, this is where the current price is. So you want to identify the support levels that is below where the current price is. So as you can see down here, I've already drawn two lines below, all right, down here. And then you also want to find the resistance levels that is above the current price. So in this case, you can see I've drawn two resistance level down here. So the whole idea down here is that you want to choose the strikes that is beyond this support and resistance levels, right? You want to choose the strike price that is above the resistance levels, and the put side, you want to choose the strike that is below the support level. So in this case, let's say, for example, if the market starts to move, at least there is a good chance or a rather higher probability that the market could bounce back up. And on the upside as well, let's say, for example, if the market goes up, then at least there's some chance, because there's a resistance level, that the market can come down. All right, so that is why we want to choose our strikes that is beyond the support and resistance levels. Now, you notice that there is actually another resistance level up here. Now, the thing is that you could also go for a strike price that is above this resistance level. So this way, you know, there are two resistance levels, right? This is the first resistance level, and this is the second resistance level. So this way, you know, it makes it a little bit harder for the price to, you know, get past these levels. And the whole idea is that for the Iron Condor, we want it to stay within our short strikes as much as possible, right? Between our short legs. But the thing is that, let's say, for example, you want to place this short strike down here for the short call side above this price. But what you notice is that if you go to the option chain and you see that the premium for this short call is going to be so little and it's very, very far out of the money, then, you know, there's no point for you to put on this one, right? So instead, you do not want to go for that one, right? So we don't go for this, and you go for the other one, right? So at least this one is nearer to where the current market price is, then you at least have some sort of premium. So this is a balance that you need to kind of strike, right? So if at certain points, let's say, for example, you found the strikes that is beyond this support and resistance levels, but the problem is that you may not be getting as much premium as you like to, then you may have to wait, right? Maybe you have to wait for the market to go travel towards, you know, closer towards either of the support resistance level. Then from here, there is another support level. Then you can start to place, you know, your short call and your short put beyond these two levels, right? So this is where you really need to take a look at the option chain at that point in time before you decide to put on the strikes. Now, the second method is using the expected move. So this is the preferred choice for myself. So what is the expected move? So in layman terms, the expected move is the theoretical calculated range that the underlying is expected to be in by a certain time. So let's say, for example, you want to know, you know, this underlying down here, what is the likely price it will be at in the next 60 days, all right? So let's say 60 days. So you can see down here, this box that I've drawn down here just depicts the expected range, right? Roughly where it might be in the next 60 days. So there is a whole mathematical formula that is used to calculate this, right? So they are able to kind of have a theory as to where the price could be at in the next 60 days, right? So this is what you call the expected move. Now, next, you need to understand the difference between the expected move and the realized move. So the realized move is the actual move that the underlying makes, right? So basically, the expected move is what the calculation is trying to predict, and the realized move is the actual move in the market itself. Right, so as you can see down here, more often than not, the realized move is smaller than the expected move, right? So the green color down here, I've already drawn this box down here to show you this is the realized move, whereas the orange box is the expected move. So as you can see, most of the time, the realized move is actually going to be smaller than the expected move. So what does this mean? So this means that if you choose the strike price at the expected move, you will win more often than not. So how do I know this is true? Well, there is a whole study already done by the Tasty Trade team, right? So the Tasty Trade research team, they have done quite a bit of studies on this to measure the average expected move against the average realized move. And as you can see down here, this is a study on SPY. So they have even broken it down to the different volatility levels, right? You have volatility levels from 0 to 20, 20 to 40, all the way to 75 plus. So as you can see, in all the different volatility levels, the expected move is always greater than the realized move, right? So this is for SPY. And by the way, this is a pretty significant study set because it is across numerous years, right? I think they have a study set for over a decade or so. So this is for IWM. Again, as you can see, it's the same. The average realized move is lesser than the average expected move. And for the QQQ as well, the average realized move is also lesser than the average expected move. So when you choose the strike prices based on the expected move, you will be able to be profitable. You'll be able to have the prices of the underlying stay within this zone more often than it doesn't. Now, you might be wondering, so how do I choose the strike prices based on the expected move? So there are two ways. So the first way is using the expected move formula. By the way, there's no need for you to calculate by yourself, which I'm going to show you later. And the second way is by using the 16 delta option. So this is the theoretical expected occurrences within the range, right? So basically this is the orange color box down here, right? So the theory suggests that the prices of the underlying would be staying within this range 68% of the time. But I want you to take a look at this, right? So this down here says the actual occurrences within this range, which means to say this is the realized move. So as you can see, it is much greater than 68%, right? Anywhere from 71% to 85%. So these are the two ways that you can use to calculate the expected move and choose your strike prices. Now, one thing I want to point out is that 16 delta options usually is wider than the expected move, right? So this percentage down here, you notice that the percentage for the 16 delta move is only 71%, whereas the expected move formula shows 85%, right? But if you were to go to the option chain, you will notice that the expected move is actually has a smaller range compared to if you place your strikes at 16 deltas. So I think the stats down here have been switched, all right? I think there was a kind of a mix-up down here because the 16 delta options, right, is wider than the actual expected move depicted by the formula. So I think the stats down here that you see on the 16 delta options belongs to the expected move formula, and the stats for the expected move formula belongs to the 16 delta options, which means to say if you choose the 16 delta options, the chances of the price staying within that zone is going to be far greater than if you choose the strike prices based on the expected move, right? So you might be wondering, how do you choose, the prices, the strike price based on the expected move? So you do not actually have to calculate this yourself, because if you were to open up your option chain, you actually already see it at the right-hand corner, right? At the top right-hand corner. So you can see down here, there's this number plus minus 18.03. So basically this is the range, right? You take where the current price is. So let's say the current price right now is 184.36. All you have to do is add 18 points to the top. All right, and then you have to minus 18 point at the bottom, and that will give you the expected range. Now, of course, this is not drawn to scale, but you get the point, right? So this is for the expected move formula. Now, the other way is by using the 16 delta. So you need to go and find the column that says delta, right? So down here, it would say delta, and then you will be able to see all the different delta for the strike prices. So this is for the put side. So as you can see down here, I already have a position at the 16 delta mark, right? At the 16 delta strike price. So as you can see, I practice what I preach. Now on the call side as well, you also want to choose the 16 delta, right? So that is how you can choose the strike prices based on the expected move. So now that we have already chosen the short legs, The next step is how do you decide what strike price to choose for the long legs. By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. Right, and again, there are 2 methods for this. So the very first method is by using a fixed width. So for example, maybe you have a $1 wide Iron Condor, and you also have a $3 wide Iron Condor or a $5 wide Iron Condor. Then from there, you will basically just increase the contract sizes based on your risk per trade. So let's just say, for example, on this $1 wide wing Iron Condor, maybe you get, I don't know, 35 cents. All right, this is a dollar sign. Maybe you get 35 cents in terms of credit, and the max risk for this will then be 65 cents, right? So if you are trading one contract, it means to say your credit you're going to receive is $35 and your max risk is going to be $65. So what many people will do is that they will actually increase their contract size based on this, right? So let's say, for example, you can risk $650 per trade. All right, let's say you have decided that the max risk you can take on per trade is $650. Now, because one contract based on a $1 wide Iron Condor, your max risk is $65. So how many contracts can you trade to make up this $650 in terms of the risk? Well, the answer would be 10 contracts, right? So this is what a lot of people do, right? They basically just put on many contracts and have a very tight wing Iron Condor. Now, I'm not a big fan of this, and I've mentioned this in many other videos as well. And the main reason is that it's actually much easier for your max loss to be hit, right? Because the market, it doesn't have to move much just to hit your max loss, right? As you can see, it's only $1 away from where you put your short strike. So if the market just goes below your long strike, at this point, let's say it settles at 177, at expiration, then guess what? You're going to lose everything that you risk down here, right? But if you put on a wider one, let's say, for example, you put a wider one, $5 wide wing, then if, let's say, for example, the market goes to 177, then at expiration, you're actually not going to lose as much as compared to, you know, putting on the $1 wide wing. So that is why I don't really like this kind of a method to just, you know, have a fixed width and then just keep increasing your contract. So my preferred method is actually method number 2, and that is to expand your width to fit your allocated risk per trade. So what do I mean? So let's say, for example, if you have $500 to risk per trade, then you first want to start off with a 5-point wide wing and then work your way to reach your allocated risk per trade. Okay, so let's say, for example, this is the Iron Condor that you put on, and this is a $5 wide wing on both sides, right? So they are equidistant. So at this point of time, you take a look at your trade and you notice that your credit is $1.20 and your risk is $3.80, which means to say your max risk is $380 per contract. So right now, because your max risk that you have decided on this trade can be up to $500, you actually still have some room for you to expand this Iron Condor wing. So what do I mean by expanding this Iron Condor wing? So what you want to do is basically just adjust the long strike by another strike, right? You just widen it out by another strike. So from here, you notice that I've widened it by just 1 point, right? From here, it was 197. Then you stretch it out to 198. And on the other side, the put side, same thing as well. You stretch it 1 point away. So now it becomes 174. So if you take a look at the credit right now, maybe it would say $1.60 and your risk is $440, right? $4.40, basically one contract is $440. And again, you still have some room to reach the $500. So what do you do next? Again, you expand your wings, right? So you widen out your wings even further. And now you have a 7-point wide wing. So now you take a look at your credit is $2 and now your risk is $5, which means to say one contract is $500. And that means you have already hit this risk per trade that you want to put on for this trade. Now, if you compare this, which one do you think is much riskier, right? So let me just remove this drawing. So let's say, for example, both right now could be already risking $500, right? Let's just assume the fact that this person down here maybe put on many contracts. All right, let's just say, for example, you have 8 contracts on down here, and the max risk is also $500. Okay, so in terms of the max risk, by the way, this is a dollar sign. Let me just draw this properly. So the max risk right now is $500. Both, they are the same. All right, so I show you again the other one. This one, the max risk is going to be $500. But now I want you to take a look at which one do you think is going to hit the max loss sooner, right? Let's say, for example, the market went down, and then at expiration date, right, all else being equal, that means both have the same expiration date. Let's say the price settles at $177 at expiration. So in this $1 white Iron Condor, how much do you lose? Well, you lose the whole $500 amount, right? Because the max loss that you have kept is up to this wing, the one that you have bought back. This is where you have kept your max risk, and anything that goes past that will basically be hitting your max loss. So you already have hit your max loss of $500 for this trade. Now let's take a look at the other one. Now for this, because the wing is much wider, so let's say again, the market now settles at 177 at expiration. What is your loss? Now your loss is definitely not going to be $500, because your max loss will only be hit if the market goes past this long put strike down here, right? So most likely for this one, you will only lose maybe half of it, right? Because it's somewhere in the middle of your this put spread on this side, right? So as you can see, the $1 white wing is much riskier. So if it's much riskier, why do many people actually want to go with this $1 white spread? Well, the first reason is probably they think that it's safer to have a smaller wing. But again, this is very relative to the risk per trade, right? They don't realize that by actually tightening their wing, making it so tight, it's actually riskier, right? The second thing is that you actually get much more premium. Your premiums will start to gradually taper off as you expand this wing, right? As you stretch this out. So many people, when they put on the Iron Condor or any trade for that matter, what they only like to look at is the kind of credit that they get. So yes, you may get a higher credit, but then again, you're putting yourself at a much higher risk as well. So at the end of the day, which one should you choose? It really comes down to you, because if you are the one that prioritize, I want to make as much money as possible, I want to get as much credit as possible, and you are not too concerned that, you might hit the max loss on the particular Iron Condor trade, then you could go for this one, right? You go for a very tight wing, and then you increase your contract size. At the same time, you also incur more commissions. But if you are more prioritizing your risk, that means you want to make sure that you do not lose so much each time, but you also stand a very good chance to be in profit. Then you want to go for this one. Because one other thing that I forgot to mention is that the win rate, the probability of profit, is actually higher when you expand your wings compared to if you have a very tight Iron Condor with just $1 wide. So I hope that in this way, you really now understand why it's actually better to expand your wings when you actually much more to risk, rather than stick to a $1 wide, wing Iron Condor and just increase your contract. Now, of course, if you only have, let's say, $70 to risk on a single trade, you do not have much more than that, then of course you have no choice but to go with only a $1 wide wing. Now, it's only when you can start to increase the contract, instead of considering to increase the contract, you increase your wings. Okay guys, so this is how you choose the strike price for the Iron Condors, and I hope that this has really helped you. By the way, if you like this video, then you're absolutely going to love this next video which I have for you, so go ahead and watch that video right now. Also, if you haven't already gotten your free copy of the Options Income Blueprint, you can do so just by clicking this link down here on your screen, and you'll be able to get it for free. Alright, I will see you in the next video.